Okay guys, welcome to the next video of phase 5, and in this video we're going to cover trade management. Okay, so I wanted to do markups for this, but I didn't want to essentially give you guys like a set way of going about trade management, just because there's a couple of things um, that fall into that. But anyways, I'd more so like to speak on it and then let you guys go and apply it in your own way to make it work for you. So essentially, right, with trade management, right, I've shown you guys how to find an entry. I've shown you how to risk, in terms of how much to risk, and which is obviously dependent on you. And now it's time to learn how to manage your positions, right? So there's essentially two parts to trade management. There is part one, which is scaling out, and then there's part two, which is hedging. So part one, right, when it comes to scaling out, there's two routes you can take. There is route one is you can have a set percentage of your position removed at your specifically desired targets. So this obviously falls into what kind of trader you are, whether it's an intraday trader, a swing trader, a scalper, and depending on that, you want to be able to scale out properly and not take out the entire volume of your position. For example, after your scalp BOS, after the next scalp BOS, you don't want to take out 50% if you're a swing trader, because you're kind of killing your RR like that, which is connected to true RR, which is what we're going to discuss in the last video of this section. But anyways, right, for example, you could take out, like, for example, if I was a swing trader, or since I am a swing trader, if you were a swing trader and you wanted to scale out, I would say, for example, you could do 10% at your intraday, 20% at your swing, 5% at your scalp, right? It really just depends on the scenario as well, because you could scale out more if you're, for example, catching a continuation on a swing impulse to take out a swing target, right? If that's the case, then at that swing target, you'd want to take more volume out because you're already in such a high of a premium, and you could fail, or you could essentially, the trade could fail and take you out at break even, when in reality that could just be the beginning of the overall impulse, the overall correction, the overall pullback, which leads to that discounted area. Um, so yeah, that's route one. Route two, right? As you gain experience, right, you understand where you are in price, which is essentially what we just covered with that example, right? So you want to scale out based on your overall target. For example, if you're a scalper and you're aiming for a swing high or swing low, then you obviously want to take out more volume there. Like we said, that's just a logical way of approaching this. Um, and so yeah, just make sure that you know where you are in price. Make sure you know what kind of trader you are, right? And then scale out accordingly. And I would say do it in terms of percentages of your overall position. Um, I just think that's an easier way to be efficient with it. But anyways, right, part two is hedging, right? So as a beginner, right, because I want you guys to, I stress with you guys that I want you to focus on continuations over reversals, right? Hedging you don't necessarily need when you're pro trend, but at the same time, right, when you're considering different levels of structure, one can be pro trend on one level of structure and counter trend on the other, which is why it's also important to be dynamic and to only take justified positions. So, right, if you focus on your pro trend moves, right, you will naturally learn to hedge against yourself once you start anticipating and learning how to anticipate those types of pullbacks, right? So, what exactly is a hedge though? So, a hedge is essentially a buy against your sell or a sell against your buy, right? Meaning that if I'm in a buy position, right, and my pair is wanting to start pulling back by giving those initial signs of breaks of structure, if you want, you can take a sell position countering the buy position, just in case if your buy breaks even, right, and you get a whole trend shift, or if you're just trying to cover yourself and quote unquote trap price, so that way no matter which direction the market goes, you will be correct, right, even though you're taking one loss or one break even. um, so the key to hedging is to knowing your risk, right? You can go about your risk in many different ways. You can risk 1% on your pro trend trade and then 1% on the hedge. You could do 1% on your pro trend trade and 0.5% on your hedge, which means your overall risk is minimal. but you're still covering yourself, because even if that 0.5% essentially takes out your original position, you're still in profit, right? Because that 0.5% would definitely cover your charges or your swap and everything like that. So, right, if you want to get like a bit, if you want like a more of a simpler approach to that, I would say keep your hedge in terms of lot size a much more linear way of going about it, which I don't really highly recommend, because I want you guys to practice good habits from the beginning, right? Is that your hedge position can just be less of a lot than your overall position. And, that way, that's a, simpler way of going about your hedges. So, like I said, the advantages of hedging are if you're wrong, right, you can then still catch a trade. Two, right, you risk the hedge risk is now potentially covering you if your entire bias is wrong, and maybe you misread structure in a certain way, or maybe you misread one specific level of structure in a certain way. You're now covered, right? So it's a great way to be efficient with your risk and efficient with your growth, right? Because even if you take a hedge and that hedge begins to quote unquote take out TP1, that could be a great reason to take out a partial from your original position while you're still profiting from, the hedge position, because there is a chance that that could reverse, right? Because that break of structure could be a type of disruption, or the overall sign of unwillingness, right? So you want to just be smart about it, and essentially play against yourself when you see as needed, but you always have to be able to justify a position. If you can't justify a position, then you shouldn't take it, right? So for the most part, that wraps up this video, and I'll see you guys in the next one.